Today, we will talk about long-term investing for companies and individuals. Long-term refers to the extended period of time that an asset is held. Depending on the type of security, a long-term asset can be held for as short as 1 year or for as long as 30 years or more. Long-term is one of those phrases that is so ubiquitous in finance that it has become difficult to pin down a specific meaning. The media frequently advises people to invest for the long term, but determining whether or not an investment is long-term is very subjective. A day trader, for example, would define long-term much differently than a buy-and-hold investor. A long-term investment is found on the asset side of a company's balance sheet, representing the company's investments, including stocks, bonds, real estate, and cash, that it intends to hold for more than a year. Short-term investments are mark-to-market, and any declines in their value are recognized as a loss, where increases are not recognized until sold. For many individuals, saving and investing for retirement represents their main long-term project. Real estate is often considered to be a long-term investment. Using both a long-term outlook and the power of compounding, individual investors can use the years they have between themselves and retirement to take prudent risks. A long-term investment strategy aims to hold an investment security for a year or more. Long-term investments should also be part of a diversified portfolio to reduce long-term volatility. Gold has long been considered a good investment to hedge against inflation as well as a store of value. However, data has shown that both stocks and bonds have outperformed gold in the long term, on average. Marketable securities can be most investments, including stocks, bonds, and exchange-traded funds. These types of securities are typically liquid securities that can be sold easily as there is a large number of buyers. Long-term securities are less liquid because they need to be held for a longer time to realize a profit. Bonds with longer maturities also have higher payouts over time but need to be held longer for a higher yield. Here are 2 key takeaways. 1. Long-term refers to the extended period of time that an asset is held. 2. Long-term investments are recorded on the asset side of a company's balance sheet as investments. Hope this would help. Thanks for watching.